Welcome back, investors. In the last lesson, we explored the asset side, everything a company owns. Today, we move to the side most investors quietly avoid, liabilities, what the company owes. But here is the twist. Debt isn't automatically bad. Some of the most successful companies in history grew because they used debt intelligently. So the real question isn't, does the company have debt? The real question is, can the company comfortably manage that debt even in tough times? If you understand this one idea, you will avoid 90% of beginner investing mistakes. This video is part of full balance sheet tutorial. The link to the entire step-by-step series is in the description. Just like assets, liabilities come in two buckets. Current liabilities. Example, short-term loans, accounts payable, taxes owed, interest payable. This tells you about short-term pressure, whether the company can handle its immediate commitments without stress. If current liabilities spike suddenly, that's a red flag. Long-term liabilities. Example, short-term loans, bonds, lease obligations, pension liabilities. If current liabilities represent survival, long-term liabilities represent strategy. Companies usually take long-term debt for expansion, scaling, or investing in future growth, not to stay alive. Debt is one of the most misunderstood areas in finance. Some investors see debt and panic. Others see zero debt and assume perfection. But the truth lies in the middle. Some of the strongest companies in the world scale faster because they use leverage. Think about this. If a company borrows money at 6% interest rate but earns 15 to 20% on that capital, debt becomes a growth engine. But if company borrows money just to survive, pay salaries, or refinance old loans, that's when debt turns dangerous. Two ratios you must learn. Debt to equity ratio. This shows how much debt the company has relative to shareholders' money. Interest coverage ratio. It shows whether earnings can comfortably pay interest. We will cover both of these ratios in detail later in this series. The rule of thumb. If the company's operating earnings easily cover interest, debt is manageable. If earnings struggle, the debt becomes a countdown timer. Debt isn't a threat. Mismanaged debt is. Not all liabilities are bad. In fact, some are signs of power. Let's look at two of the strongest ones. Accounts payable. This money the company owes suppliers but hasn't paid yet. Companies with strong bargaining power negotiate long-term payment terms. That means they can sell the product first, get money from customers, and pay suppliers later. The supplier is indirectly funding the business. That's a competitive advantage. Deferred revenue. This happens when a company gets paid before delivering the service. Think subscription companies like Netflix, Adobe, Salesforce. They receive the cash upfront. Deferred revenue means cash in hand, no service delivered yet, zero financing cost. For investors, this is one of the healthiest liability lines because it represents future guaranteed income. Liabilities tell a story. Are we looking at a company that operates from a position of strength, balance, or desperation? Some borrowing accelerates growth. Reckless borrowing destroys it. And hidden in this section, especially accounts payable and deferred revenue, are clues about the company's business model, pricing power, and future stability. Your turn. Comment below. Do you prefer companies with zero debt or companies that take strategic debt to grow faster? There is no right or wrong, only insight. Next episode, we explore the real part of the balance sheet, shareholders' equity, the real ownership story. Don't miss it.